Yeah, so on a very simple level, this is kind of right. This is what acquisitions all comes down to, right? The market wants X price and we're a buyer at Y price. And if those prices intersect, then hopefully we have a real shot at buying the deal. There's other things than price that go into buying a deal. Obviously, right? Terms, reputation, just anything that's going on, with the bidding process and things like that. But right, as far as general acquisitions go, when there is an intersection between what the market wants and what we're able to pay, that's what we pursue the heaviest. But for the vast majority of deals, we don't get there, and that's how we filter through deals, and actually find things that we want to buy. So yeah, this is a key component. But to take it a step further and ask the question, okay, why is guidance pricing here and our pricing here? And for that, like Charles was saying, here are the valuation metrics, which, to clarify, right, the ask is the guidance pricing. And so you've got the underwritten cap rate at the guidance, the yield on cost at the guidance, and then that spread. And so yield on cost is your pro forma NOI divided by your purchase price and your CapEx. So it's kind of your future cap rate, what you can operate the property at on a cap rate basis in the future based on your budget, your business plan. So cap rate's important, but yield on cost is more important, because we can take a 2 cap deal and make it a 6% yield on cost through the business plan. Similarly, we could take a 4 cap deal and maybe not be able to do anything with it, and therefore that 4 cap deal is a bad deal. But what you'll see as we go through these numbers later is that, in fact, a 4 cap is actually quite a good deal, just depending on what else is available for your value add, right? Buying a stabilized deal at a 4 cap is not exciting. But so that's why cap rate is secondary to yield on cost. Yield on cost is king, really, but it's not king in absolute terms, because it all depends on risk. And that's something that we'll try to emphasize as we go through it, which is, you can't just look at a deal that's projected to be a 30% IRR and say, well, that's the best deal in this whole spreadsheet. That's the deal you should buy, because maybe that 30% comes along with it untenable risks, and everyone's risk tolerance is different, but right, untenable risks could be location, it could be just difficulties with executing the business plan and things like that. So these metrics are for the guidance, and then similarly, this is for our pricing, right? So just to give you an example, yeah, Charles, you can go ahead.
Which, each row is a deal that's been underwritten with its own model and its own spreadsheet with operational projections and stabilization and rank comps and everything. So it's really a sort of our assessment of what we think the plan is going to be. So, that is the one thing about, like, the ask is kind of, to some extent, well, the yield on cost is always going to be including our plan, what we think is possible to achieve. But like the cap rate going in is kind of more what that is, just when you take it as it is.
Right, and just to discuss methodology a little bit more, UW, or underwritten cap rate, here and here, what that is we are adjusting the in-place financials for property taxes. So we adjust property taxes for what we think they'll reassess to. We really adjust all the expenses, right? Because we don't care what the seller was operating the property at. If they were lying to their lender and not paying insurance, that doesn't affect our cap rate. We're going to pay insurance. So we don't value the property greater because the seller doesn't pay a management fee or something like that. So we automatically adjust all the expenses based on really market-based expenses for ourselves. And then we keep revenue pretty much the same. So that's how we adjust the cap rate and really ideally compare apples to apples. And so that's what we aim for here. And so you can just see, right, as this first example, the underwritten cap rate at the ask price was 3.2%. And then for us, the price that made sense for us was at a 3.6 cap. So you can see that's the slight differential in price, which it looks like this was an off-market deal with no guidance pricing, but that's what would make up that difference between the ask price and our value.
Well, pricing's there and per unit, just not absolute. So
got it. Oh, I see. Yeah. So yeah, Charles has to, of course, hide some of the data so that people don't figure out all this secret sauce that's happening here, and the brokers don't get mad at us for spilling the beans. But yeah, so you can see that's the difference. You know, they want 150,000 per unit. We want to pay 133. Similar ideas as far as the IRRs, right? That's kind of at the end of the day what we're all interested in is IRR, right? That's what we invest for as a primary metric. So you can see if you were to pay that 3.2 cap, you'd be accepting a 12.3% IRR per underwriting, right? Some other buyer may look at that deal and say, well, you know what, I see way more upside. I can renovate and raise rents way more. And they're going to project a higher IRR, and that's fine. But just, you know, for us, we view that asking price resulting in a 12.3% projected IRR. And looks like we were being a bit greedy here, but we were looking for a 28.2% project IRR. So there must have been some story as to why we needed such a big IRR. Could have been a loan assumption. It could have been just a risky deal in a worse area. But we'll talk about return hurdles.
Yeah, so I believe this one was, if you see the market is TX, Texas, so it's not in a major metro area, which is one of the reasons why that IRR demand there is pretty high, because, you know, we're not an operational footprint there, and just like, you're not going to be, you know, for going out of the blue chip areas, you're going to want a premium.
Yeah, that's exactly right. So we and everyone's different, right? Some other sponsors may take the approach that buying in tertiary markets is their strategic advantage, and they'll pay essentially major market pricing for tertiary market deals and be able to project, you know, the same or better IRRs, which looks attractive. But we are kind of swimming in the opposite direction, and it's very sensitive to, we used to buy in smaller markets, but now we're really just focusing on the major markets. So that doesn't mean that we won't look at the smaller markets, but we're just going to really be harsh on the deal and demand, like Charles said, a high IRR to entice us to want to make a move that we otherwise don't really want to make. So that's a good point. So now that you've gotten a sense of the methodology and you can look through this data and whatnot and kind of see what's going on, I think something that's really interesting is, before we look at the quarter over quarter analysis and stuff, just to get a sense of what's happening this quarter, and that is this row right here. So Charles, you want to talk about kind of what we're seeing and what's driving maybe some of the skews in these numbers?
Well, sure. Yeah. I mean, so I guess we're saying that, you know, from our underwritten cap rates, you know, we've got an average of 3.1 cap. You know, I think doesn't sound, you know, high, and I don't think that cap rates have got wider this quarter probably, but maybe at the same time it's not really 3, because if you scroll up, you can see there are a couple of deals at a 0, you know, and there's one at a negative. So, you know, it's possible there's a little bit of skew there. You know, we looked at a couple, like I think this was a lease up deal, for example, that's sort of out of our usual ken, but is something that we're doing. You looked at one, and so that alone, you know, almost can, just a few of these things can kind of bring you down the cap rate. But yeah, I mean, you know, stabilized yield on cost 5.3, that's pretty reasonable. It's actually, you know, where we're targeting a similar level of kind of stabilized yield to kind of between, I guess, Q2 and Q3, you know, spread of 2.3. So, you know, with the lower going in cap rate, you're going to need a higher spread, you're going to do more to get to where you need to be. And so that's why the spread is higher. You know, we're targeting the same stabilized yield or slightly better, but we have to do more work to get there. Yeah, I mean, so that's I think. Right?
Yeah, so for I would say what's most helpful, like I said before, cap rates aren't everything, but one of the things that's most helpful about doing this analysis and spending time looking at the cap rates is to really get a sense of market cap rates and figure out what our deal is trading for, and therefore what could I sell a property for on a cap rate basis. And that's not so simple. You can't just look at the numbers and make that decision, because all deals are different. Because it could, like Charles said, be a lease up, or it could be stabilized, or it could be a loan assumption, which would drive an above market cap rate. So what we're trying to do is look at the numbers, and like, for example, we have percentile metrics here. And if you look at the 50th percentile on a cap rate basis, the 50th percentile is 3.1, 60th is 3.3, 3.6. So, I mean, from this, I can safely say that if you're buying kind of an average deal in the market right now, the cap rate is roughly 3.5 on a underwritten tax adjusted basis. So that influences our exit cap projections. So we feel comfortable with exit cap rates today of roughly 4.75 to up to 5.25. So that's kind of our range, and we feel that that's easily justified by what's actually happening in the market right now, which you can see it here in the numbers. So that's one point about cap rates.
Right, because you could say, oh, we should be conservative, and well, it should be a 4.75 or whatever is really, really aggressive. But I mean, if you were to see a 4.75 cap out there right now, I mean, it's like the best deal around. So I mean,
yeah, we were able to buy. I mean, yeah, the best deals that on a cap rate basis that we bought last year were about 4.75, and those are very rare opportunities. So the majority of deals are trading for sub 3 caps easily. So yeah, that's the scenario. So that's how because we have a lot of investors who maybe they have been investing for a long time, and so they're kind of biased by history, and they think, oh well, you should use a 5.5 exit cap or a 5 cap on exit, which is fine. Everyone needs to underwrite their own way, but you can't ignore this data and methodology. So that's some of the conversations that we have behind the scenes, and this is one way that we support our underwriting with data. So one of the other interesting things to look at in this spreadsheet is the quarter over quarter trends and figure out what's happening as far as our cap rates compressing, our deal, what's going on. So want to just kind of share what we're seeing lately, and then we'll answer Justin's question.
You mean about like kind of this ratio here?
No, well, anything, just any changes that are happening quarter over quarter. What did this quarter look like versus previous?
For us or for the market?
Both.
Well, yeah, I mean, I guess, seems like pricing seems to kind of go up. So which is what else is new recently, at least. I mean, Q4 average guidance per door 116, Q3 was at 107, Q2 was at 99, Q1 was at 90. So, it seems to keep going up, and the cap rates seem to keep going down as far as we can see. 4.1, 3.8, 3.4, 3.1. Although, so yeah, I mean, and you have to keep doing more to make things work. And also, in fact, our hit rate has also fallen just ever so slightly. I mean, our 50th percentile bid ask ratio used to be 92%, right? And now we're 91. 70th percentile, I guess at 70th percentile, we're actually kind of the same, but look at 80th, now, so the 80th percentile deal, we're now at 97% of the price, whereas last quarter for the 80th percentile, we were actually basically there. So it's getting tougher for us to kind of hit stuff in the market, so pricing goes up, and, we kind of work with it, but, it's tough to find a good deal now.
Yeah, we definitely felt in Q4 things tighten and get more aggressive. So I don't know where things are going to go moving forward. We're going to have more activity with NMHC coming out next week. So there's going to be a lot of deals coming out. So we'll see if things loosen up, tighten up. Also, there's the changes that are potentially happening on the capital market side with interest rate increases. So that may or may not affect pricing or the the attractiveness of opportunity. I mean, just because interest rates go up doesn't mean that cap rates have to go up. So that is it just all depends what's going on right now. We also are dealing with inflation. So yeah, so we have a few more talking points, but we'll take a pause and answer some questions. If you do have questions, please feel free, put them in the chat, or if you want to unmute yourself, we could do that as well. Justin has a question about basing our exit caps off of the market cap rate. We do base it on the market. So the distinction there is between basing it on your deal cap rate and the market cap rate. So we definitely do it on the market, right? Just because we buy a deal that's, let's say 50% occupied and it's a 1 cap doesn't mean we're going to exit at a 2 cap and call it conservative. So the market that we feel is today roughly 3.5 to, if I'm being kind of generous, I'm going to say 3.5 to 4% and then we're going to exit roughly 50 basis points wide of that, plus another 25 points to tax adjust the exit. So, you know, if you're not familiar with what that means, some people choose to, when they revert, when they do their reversion analysis to derive their sales price, they'll go ahead and bump their taxes based on that future sales price, or they'll just bump it by 10%, 20%, whatever they want to do with taxes. And then they'll put a cap rate on it. And that's how they get their exit price. We don't tax adjust our exit. So what we do is we just add kind of roughly another 25 basis points on the exit cap rate. So if you were tax adjusted, maybe you would exit at a 4.5, but then you add another 25, and now you're at 475. So that's kind of the idea there of what we're doing. And, you know, just to give you an idea, we're buying a deal, actually, yeah, so we're buying 2 deals right now that have pretty similar buy sells. We're buying these deals for 4.1 caps, and we are projecting an exit cap rate of 475. So a couple things are happening there. Number one, we think we're getting a great deal. We think we're buying at an above market cap rate, right? It's off market. So that 4.1 cap is more than the market, right? We think the market's kind of maybe more like 375, 350. And so that's one point. And then we're again exiting at 475, which is that spread. Another question is about LOIs, which is a great topic. And I'll let Charles answer it about, you know, putting in LOIs below the guidance.
Well, I think if it's marketed, at least these days, there doesn't seem much point. You can just verbal it, tell them on the phone or email them, like whatever. But I mean, if it's off market and you're trying to get, you know, a discussion going, but maybe you haven't seen it yet, you know, and you need to get a tour, you know, maybe you know, and the other thing is they're going to want to get something out of you. So if you kind of go in, you know, right at the number, then it's all a little bit silly, isn't it? But, you know, so yeah, I mean, I guess I would say, like, if it's like off market and you're trying to shake it loose, like that's one approach, right? It sort of depends, because of course you could also argue for like you just come in hot, but yeah, I definitely do put in LOIs sometimes well below guidance for off market deals.
Yeah, like Charles was saying, you have to know the broker or the situation, whether an LOI is help. I mean, it's never really a bad thing, but it's sometimes just kind of extra work that you don't really need to do. And if you, like Charles was saying, if you put in the LOI, expect the broker to kind of take that and want to now push you and get you for another bid. So if you kind of put a half-hearted LOI in to just kind of say, hey, I'm done with this deal, but this is my low price, you know, they might come back to you and say, well, how about a little squeeze here, and why don't you check the financials and come up a little bit. So that
you're coming in at a number that you're really comfortable with, you know, you think this is pretty good. I could find out a couple bad things about the deal and I'm still happy with it. Then like you get some traction with that, maybe you get a tour, maybe, you know, you find out a lot more info from the seller, get more comfortable, and you tighten everything up, and then you can pay more.
I feel like generally speaking, unless it's something really interesting off market, you have a captive seller who wants to sell and there's a deal to be made. Outside of that situation, I think these days, it really doesn't make that much sense for us to come in with an LOI unless we're coming in hot and we're really willing to pursue this deal to the end, and we've got more juice in the tank, and we just love the deal. So I think that's been our latest approach. Next question is about planning and underwriting for interest rate increases. So the way that we're doing that is simply through a forward curve. So built into our underwriting model is a SOFR forward curve, which now most of our loans are based on SOFR, not LIBOR, as far as floating rates. So to the extent we're doing a floater, we are factoring in the monthly interest payments based on the forward curve, which is the future projections of SOFR, which is again the index rate. So that's how we're handling that. And then for fixed rate financing or for refis, we don't really underwrite refinances into our underwriting. So we're not really making a forecast about future fixed rates. We are essentially implicitly making a interest rate bet via our exit cap rate. because I mean, there is a correlation there, not 100%. So, you know, if you're the type of person who believes that interest rates are going to go to the moon, then you wouldn't underwrite a 4.75% exit cap rate, because why would people buy real estate at 4.75% if interest rates are 5%? So that certainly is an implicit assumption that everyone's making today about interest rates. But other than that, we're not really making big interest rate calls in our deals. And our best tool in our tool belt to combat rising interest rates, and more importantly, what everyone is really worried about that comes along with rising interest rates, is a decrease in valuations. And the best tool to fight that is to be able to live on your cash flow. If you buy a deal and valuations go down, cash flows don't necessarily have to go down, right? Just because interest rates go up and investors are willing to pay less for your deal, you can just still cash flow and stay in the deal. So it's important to be able to have the nimbleness to maybe go from a bridge to a perm loan, to maybe go from a floater to a fixed rate loan, and just put yourself in the best position to optimize for cash flow, rather than trying to make an exit when the market may not be there. Right now, the market's there. So everyone's looking like a genius. People are buying, they're selling, they're doing so in a shorter period of time. Cash flow is very secondary. People aren't optimizing for cash flow.
Well, you can't buy anything that's going to cash flow. I mean, unless you put in a big equity check. I mean, because you know, the 4.1 cap just doesn't really support it, you know. So everyone's buying a bridge and, you know, all this stuff. So
right. Yeah, we're maybe going to be able to do 1 to 2 deals a year. I mean, yeah, I'd like to do 2 deals where we're buying with great in-place cash flow, long-term agency financing, and do that. But like Charles said, it's rare. So we'll do a couple more questions, and then we've got some more going on. So planned hold periods on deals at 4.1 caps. So for us, when we are doing a bridge loan, we'll underwrite to a 3-year hold. I recently made a video about that. You can check out on YouTube about that. Also, a while ago, I did a podcast with Bo Berry, who's an awesome broker in Florida, and he has got a great YouTube channel. We did a podcast together, and we talked about, you know, how to come in hot and the strategy for LOIs and things like that. I think he has a great perspective, so you can check that out as well. But as far as our hold periods for bridge, we do 3-year hold periods, not because we have to hold it for 3 years, but simply we want the underwritten time period to be coterminous with the initial term of the bridge loan. We just feel like that's the most intellectually honest way to go about things without making things more complicated than they need to be, such as by assuming the exercise of your extension options, which is not an attractive thing to do, because extension options cost money and you often amortize in your extension period. So yeah, you don't want to be on a bridge longer than you need to, but nor do you want to bake in a refi into your underwriting. So the 3-year hold is how we solve for the bridge underwritings. And then if it's perm debt, we'll do a 5-year hold. So that's the only thing that influences our underwritten hold periods. And as far as cash on cash returns, I would say investors are pretty comfortable with the cash on cash returns that we're projecting. I think our cash on cash returns are pretty conservative. It's a little bit of a different conversation, but we bake in below the line expenses with replacement reserves, recurring CapEx, and different escrows and things like that that actually undersell hopefully our cash flows. But we're, you know, our last few deals we've been pitching investors, I think, what, 6-7%.
Yeah, I mean, we'll build the better. But I guess my other thought on this one particularly is kind of, I mean, it's a little bit of a, you know, you're just kind of bragging to yourself about the quality of the deal that you're able to snag a 4.1 cap. Doesn't mean that the, you know, it's going to be pulling out a 9 cash flow in year 1 or something. It's relatively good. It's not absolutely incredible.
Yeah. Right. So last question, do you feel obligated to put in an LOI if we tour the property? No, not at all.
It's a waste of time, because, like, you know, you should put in an LOI if you believe in the price you put in the LOI, right? Like, that's if you want to buy it at the price in your LOI, but what's the point? You know, it's just a waste of everyone's time, and the broker's job is, you know, so, you know, that way you're going to be more credible when you do put in LOIs.
Right. They go, oh, they're putting in a LOI, they've toured, they're excited about this deal. Let's make it happen for them. So a couple other angles of discussion, which one of the things we usually talk about is off market versus on market. So what's going on there?
Well, yeah, I mean, I think so this quarter, obviously, you can see we've looked at 33 marketed and 32 off market. Last quarter, we looked at 54 marketed and 26 off market. So we looked at a lot more marketed and just a little bit fewer off market last quarter. So I think, to some extent, we've been working on a couple of bigger deals, and we've kind of get a little picky. Just it's very competitive, also, with the market deals these days. So of course, that's somewhat of a disincentive to just pursuing every single market deal that turns up on your desk. And I think also maybe to some extent, there's also just, there are fewer marketed deals maybe towards the, because this quarter does include December, and that kind of becomes the holiday month. But yeah, so, we kind of been trying to focus efficiency on kind of, like off market type things where we maybe have a shot of actually winning, getting an interesting deal, and doing that this quarter a little bit.
So a new angle for us is, I think we talked about this last time, is the move into DFW. DFW has been something that we've been kind of observing from afar. We've looked at deals there, we've partnered on deals there, but for 2022, Lone Star wants to make a big push into Dallas-Fort Worth. So of course, we need to look at a ton of deals there. So the goal would be to actually build it up to where we're looking at, I'd say, the same amount of deal flow from both Houston and DFW. And with that, we'll have really interesting data to be able to compare side by side two markets and look at all this trade tracker information on a dual market basis and be able to actually identify the differences between the markets. Anecdotally, we've felt that Houston was always cheaper than DFW, and on a price per unit basis, on a cap rate basis, on a projected return basis. And anecdotally, we've also seen that compress. Houston has been a great performer, and I think Houston's closed the gap a little bit between DFW and Houston as far as pricing and things like that. And based on our preliminary data, this is very new. We don't have a ton of DFW deals in here, so stay tuned. This is just a teaser, but on our early data, it seems that there isn't really much of a difference. So aside from price per unit.
Yeah, I mean, I think, but I don't know if that speaks to like that, Houston, it's just kind of that it's tough out there, and a lot of deals are just stretched to what is the debt going to, limit you at, basically, and that's not even that sort of, I mean, market wise, I guess there's some variation, but that's kind of one of the big things. So, you're just kind of they're both going to be stretched to the limit. So yeah, I mean, so looking here, we can see that we're showing the same cap rate, just about maybe 1/10 of the point difference between the two markets, but not a huge difference. I mean, the deals are bigger in dollars a door, so that is kind of the big difference that we've seen, is that Dallas is at 140 and Houston we're still at 110. So
all right. So, and then as far as us and what we're up to, I mentioned that we were buying a couple of deals. We've been buying a couple of deals. We're selling a couple of deals. One of the trends that we're seeing is we've been looking at larger deals. I don't necessarily think that we are passing on smaller deals. I think just more larger deals are coming across our desk. And maybe 6 months ago or a year ago, we would get a $50 million deal, and maybe we'd underwrite it, but we didn't really want to pursue it that heavily just because our confidence behind that wasn't so strong. And maybe we needed to have it to be a really good $50 million deal to do it. But our team has grown, our capabilities has grown, our reputation and all that. So we feel confident in $50 million deals now. So I think and the brokers are confident in us as well. So naturally, larger deals are coming our way. So Charles here has a note about, deal quarter over quarter, we've gone from average deal size 22 million to 28 million that we're looking at. And, we just bought a $35 million deal last month.
Right. Yeah. And so, I mean, you kind of attribute some of it, so you figure the deals that got bigger, 22 to 28. I think that's where it's at here. That's, I think that's actually Houston specifically. But anyway, yeah. So anyway, the deals got bigger, right? But we've also got increased unit count, and then we got increased price per door, right? So the unit count is increased from 236 to 270 that we're pursuing, right? So we have increased like what we're targeting, just in terms of size of units, but then also the price per door has gone up. It would appear in the market, from 107 to 116 or so. So So that's also attributing part of that as well. And both of those fall into the total dollar size.
I think this difference,
22 to 28. Yeah. There.
right.
Yeah.
I think this difference is also not this difference, but this difference between price per unit. I think it also has to do with the quality of deals that we've been looking at. I mean, just the way it feels to me is lately we've been looking at more institutional deals in better locations, and obviously a higher price that comes with it. Yeah, I think that's pretty much mostly it. Any other?
Discuss the business plan thing. Yeah, I mean,
Yeah, go ahead.
well, yeah, I mean, so I guess we kind of discussed this. We touched on this earlier, but yeah, I mean, I guess the last point that we kind of did have was just that, you know, for example, you can see it in CapEx budgets, you know, and maybe some of that's inflation that we just are seeing cost increases, and we want to be sure that we're covered. You know, I think that's definitely part of it, but it's also that, so you can see that last quarter, the stabilized NOI projection was 57.73, and now it's 65.50. You know, and if you're going in at a lower cap rate, then you need to have a better end result in order to make it worth your while, right? And so you're seeing like more operations are needed to achieve a good investment, and likewise more capex. Like maybe some of that is cost increase, and some of it is also being more ambitious about what you're going to do so you can still turn a profit.
I think also we are just playing it safe. There's just no reason in trying to put together a razor thin capex budget and then figure out, oh, there's a little bit of inflation and now you're over budget, or you actually wanted to do more, to, like Charles was saying, to push rents or what.
Right, because the opposite of that is saying that you're going to budget less and you're still going to achieve the same rents. So I mean, you know, you want to, yeah, make sure you're equipped.
Right. So it's just better to have a bigger budget, all else being equal, of course. So yeah, I think that pretty much wraps it up for what we have prepared. If there's more questions, you know, feel free to open it up. Questions about the tracker, questions about just acquisitions in general. You know, we're here.
Hey, Rob, I have a quick question for you.
Yep, go ahead.
Getting back into the CapEx, have you seen either in Houston or your current projects where the supply chain not only increasing cost, but increasing the timeline, and how you guys accounting for that? Like say you're doing a value add, and you might want to add like a couple of months to your renovation downtime per unit or something like that. Have you seen that impact that at all, or has it just been mainly on the cost side?
For the scope of what we do, typically, we haven't really seen much delays. We have pivoted in some ways. If you know, if a certain project would take longer, then we'll just, I don't know, do a different project first. But typically it's really cost going up a bit, and not really delays in timing.
Well, I think we also allow ourselves some time, right? I mean, if you were going to be really aggressive, you could kind of use a calculation of like how many units do we have vacant and how many months do we need to, you know, turn all of those vacants. And a lot of the times that might come in a year and a half, maybe after you stabilize. But we really tend to stick with 2 years as a minimum. So that kind of just builds in a little bit of padding as well, that we're not maybe going to be totally out to dry if something does happen.
Yeah, we usually do beat our stabilization timeline. That's something that we're fairly conservative on. So yeah, that's a good point. Well, if there are no more questions, we can wrap it up. Hopefully this was a productive session. Let us know how we can improve the presentation. I know we had a little bit of technical difficulties, but usually we do a little better. So yeah, like I said at the beginning, we put this together on a quarterly basis. So we go over our quarterly deal flow, and yeah, let us know if there's something that we didn't cover that you want us to cover next time. As far as the template deal tracker, we have a template, so we have a blank one that we can share, so you could do this for yourself and you can build it on your own. I'm not sure, are we sharing this out, this document out?
Well, we might need to tweak a couple things at the very minimum, I think, but maybe.
All right, yeah, I can't remember if we're sharing this thing or not anymore, but yeah, so we could definitely share out the
blank, which is what you asked for. We'll definitely have that.
We can definitely share out the blank. So we'll, yeah, just feel free to shoot me an email, and we may, whatever we decide to include, we'll include in the follow-up email to this. Everyone who was on this recording and that registered will get a follow-up email here shortly. So look out for that. And yeah, so hopefully, Ed, you just heard, we will, this was recorded. We'll be sharing out the recording, and whatever that we're sharing, the tracker wise, that'll be going out later today.
Sweet. Thanks, guys.
Thank you
Yeah,
very
thanks
much.
a lot. Appreciate it.
Absolutely appreciate it. All right, we'll talk
Okay.
soon.
Thank you.